This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Good Friday afternoon, everyone. Live on Bloomberg Television and Radio, streaming on YouTube and Bloomberg Originals. I'm Scarlett Fu here with Alexis Christoforous, and we're in for Carol Masser and Tim Stenivek. A lot going on this Friday, the first full week of December. No shortage of news at all this morning,
and
this afternoon.
Blockbuster, might I say, deal of the year in the media industry.
Absolutely. $72 billion media merger. Bloomberg News media and entertainment editor Felix Gillette joins us to discuss Netflix's planned acquisition of HBO and Warner Brothers' film and TV library and studios. Later on, Bloomberg Intelligence senior analyst for antitrust litigation Jennifer Rhee will help break down the industry reaction to the deal, potential legal pitfalls, and how regulators might want to step up and maybe, put some guardrails up here. And of course, we did get some eco data, some of it stale, some of it current. U.S. consumer sentiment most recently improving in December for the first time in 5 months. LinkedIn chief economist Karin Kimbrough will join us before the last Fed decision of 2025. So quickly. It comes so quickly.
And every month I said, can you believe it's November? Can you believe it's December? And now it's going to be 2026.
All right. First, though, let's get a check on the day's trade and top business news. And for that, here's Charlie Pellet.
Hi, thank you very much. Do want to begin with a developing story headline right off the Bloomberg Professional Service. U.S. Supreme Court says it will review President Trump's planned rollback of automatic birthright citizenship, setting up a high-stakes showdown over what long has been understood to be a constitutional right. Equities pushing higher. The Dow, the S&P, NASDAQ all advancing right to the numbers here. Fast-moving markets to the upside with the S&P up 15, now up 0.2%. Dow Industrials at 48,006 today on this Friday. We are on track for a winning week with the Dow right now up 150, up 0.3. NASDAQ Composite Index up 55, up by about 0.2%. Interestingly, though, a retreat for the Russell 2000 Index of small cap shares. It remains lower by 0.2%. Your 10-year at 4.13%. The 2-year 3.56%. Spot gold currently trading lower, flat on the day, down 50 cents, 42.06 the ounce. The silver is moving higher. Silver surging 2.2%, 58.40 the ounce. West Texas Intermediate crude up 0.6%, 60.02 a barrel, and Bitcoin down 3.5%, 88,950 right now on Bitcoin. It is the business story everybody's talking about. We got you covered here at Bloomberg. Netflix is buying Warner Brothers Discovery in a historic combination. Shares of Netflix down 3.6%, though. Warner Brothers Discovery up 5.3%. Cannot ignore Paramount Skydance. It is down 7.8%. Comcast up by 1.1%. We'll have a whole lot more as our coverage continues on this story. Again, recapping here, S&P up 14, up 0.2%. Bitcoin down 3.4%, 89,000 right now on Bitcoin. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thanks so much, Charlie. And we're going to stick with that big story of the day. And as I said a moment ago, possibly the year, Netflix buying out Warner Brothers Discovery, or at least wants to buy out. They still have some hurdles they're going to have to clear. This is an $82 billion deal if you include debt. We want to break it down now with Felix Gillette here in our studios. Felix is a media and entertainment editor for Bloomberg News and also the author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. The perfect person to talk to about all of this. Felix, thanks so much for being here.
My pleasure.
I guess, first of all, this is sort of your sweet spot. This is your beat. Were you surprised to see Netflix come out the winner here?
Yeah, I think it was a little surprising. I mean, I think at the start of all this, Paramount kicked off the sale by making an unsolicited bid for Warner Brothers Discovery and for the whole company, right? And they rejected 3 bids, opened it up for sale. Along came Netflix and Comcast saying we'd like part of the business, not the whole thing. But I think, in spite of Netflix's strength in Hollywood, I think people were thinking, well, they only want part of it. David Ellison, just finished his deal to combine Skydance with Paramount. His father, Larry Ellison, the co-founder of Oracle, has an enormous amount of money to back the deal. So I think a lot of people thought that the Ellisons were going to be able to pull this off. And we're surprised that Netflix was able to do it.
Well, the Ellisons might still be able to pull this off because there are reports that Paramount Skydance is considering taking its offer straight to Warner Brothers Discovery shareholders. So it's not quite over yet.
Yeah, we're all waiting the next move from the Ellisons. And they signaled some displeasure yesterday in a letter to Warner Brothers saying that they felt the process had not been fair and that, sort of laying the framework for potentially
going hostile. And they bid a higher
hostile.
price than Netflix did too, right?
It depends. It was kind of apples to oranges, right? Because they weren't bidding for the same thing. Netflix was bidding for part of the company and, Paramount Skydance was bidding for the whole thing.
But part of the company, they were still going to offer even more for part of the company than Paramount was going to give for the whole company. Is that right?
It depends how you value the part of the company that Netflix is not acquiring, which is all of those legacy cable networks.
Well, let's talk about it since you wrote the book on HBO.
Yeah.
What would let's just say, for instance, this deal goes through Netflix, Warner Brothers, Discovery. What happens to CNN, TNT? TBS, HBO.
They'll all be spun off into a standalone company, and that's going to be, it's a declining asset, but it still throws off a lot of cash. Will it be eventually potentially combined with some of the other cable networks that are now out there? It's conceivable that someone will come along and roll up what's left of all of the traditional legacy cable networks.
And I misspoke. HBO is not part of that. That would be CNN, the cable,
right?
The cable entities.
Cartoon Network, TBS, right. TNT, CNN. Yeah.
Felix, Netflix is the original disruptor. I mean, it kind of accelerated the cord cutting that we're seeing everywhere. Are we setting up for a major culture clash here by having a tech company buy a classic Hollywood studio?
Well, these deals always look great on paper, and then you start combining the assets, and often you do get culture clashes. And particularly with this company, with Warner Brothers Discovery, which was previously Warner Media, we're now 25 years into mega mergers for this company, starting with AOL Time Warner, which was one of the most disastrous, combinations in entertainment history. And then, then also the deal with AT&T buying the company later. And there was a huge culture clash there. Discovery coming along and combining assets with what remained of Warner Media also has been a turbulent ride. So, yeah, part of the question is, why would this be different? And people asked that, analysts brought that up today on the phone call with Netflix executives. And what they said is, look, we're in the entertainment business. And they didn't bring up the other companies' names, but AOL was not in the entertainment business. They were a tech company, dial-up, access to the internet in the early days. And AT&T also had, basically no entertainment industry history.
I thought Netflix was a tech company. That's what they tell investors.
Yeah, I mean, and they, there's the famous quote of that Ted Sarandos said, early in the streaming wars, where they said, he said, we have to become HBO faster than HBO becomes us. And, I think if you look back at what's happened in the, dozen years since then, Netflix was able to master the skills of an entertainment company and how to develop original programming, how to build franchises, quicker than HBO was able to master the streaming technology and distributing in this post-cable era.
I think about the culture clash, and I think about how Amazon bought MGM for $8.5 billion. And you don't hear about MGM anymore. It's kind of like it's lost its identity.
I can't imagine that would happen with Warner Brothers. But, I mean, could it? Does Netflix just become so big it overshadows these legacy brands?
Yeah, I think there's some serious questions about how these are going to fit together. And people asked today, like, what is, what's the plan? Like, is HBO going to be a standalone streaming service? Is it going to be integrated? Is it going to be like a tab on Netflix? And they said, well, hold up. We have basically a year to 18 months to figure out these questions. We're still ourselves kind of figuring out how they're going to fit together, but they see them as complementary services, complementary brands. And I think it's interesting when you think back about the past year, because in a sense, this was something that executives at Warner Brothers Discovery also came to this conclusion in the past year. They'd spent the past couple of years saying, oh, we're going to build this giant streaming service with the assets from Discovery plus assets from Warner Brothers to build a Netflix competitor. And they weren't able to catch up to Netflix in a meaningful way in terms of subscribers and in terms of the amount of time people spend on the service. And eventually, in the past 6 months, they started saying, you know what, we kind of see Netflix as a utility. Everyone has Netflix, and there's a bunch of other complementary streaming services, of which HBO Max is one. And so we're not going to try and offer everything. So in some ways, there is, other people kind of saw this come in. Maybe there's some world in which if you already have Netflix, do you buy the HBO add-on in the future from Netflix to see, the next season of Game
another
of Thrones
bundle choice is what we may have.
More bundling.
But this is more bundling. Oh, yay! Something to look forward to.
Yeah.
Real quick, Warner Brothers Discovery has a market cap of about 64. Is it 64 million? Is that right? Billion. Yeah. Why do we have million here? No, 64 billion. That's right.
Yep, 64 billion.
So are they overpaying for this? Is Netflix overpaying? Because they're not getting the whole company and they're taking on the debt.
Yeah, I mean, I think the share price is down a little bit today, so I think there is some skepticism and questions about Netflix's overall strategy. Did you run out of other things to do? There's been talk in the past of, where is Netflix's growth going to come from? Well, they did this password crackdown, efforts that, people were like, what could that really do? But it was actually pretty successful. And, then they said, okay, we're going to start doing advertising, have an ad-supported version of Netflix, which previously they'd said we're never going to do advertising.
Yeah. Oh, and sports too, right?
And sports, live sports, which is part of attracting advertising. Then what's next? So what's next is this deal. And it's not that out of the realm of what they're already doing. So I think there's some question is paying for all that additional library, how much does that help you? Especially when you look back at, say, Disney's acquisition of Fox. And their whole library, which again, huge library of really rich content, movies, TV series. And when you look back at that deal, people now think Disney maybe overpaid.
Well, certainly we know that Rupert Murdoch sold out at the right time, if nothing else. All right, Felix, appreciate your joining us this afternoon. Felix Gillette wrote the book on HBO. He is Bloomberg's media and entertainment editor and, of course, author of It's Not TV, The Spectacular Rise, Revolution, and Future of HBO. And I think you nailed it when you said, oh, bundling, yay, because the history of media is about bundling and unbundling, and now we're back to bundling once again.
Yeah, and also never say never. I think those are the two big takeaways, right,
Absolutely.
from this merger.
All right, well, we also have data that we want to get through today, some economic data. What I found really interesting was a recovery. I don't even want to call it a rebound. It's just a bit of a recovery in consumer sentiment, rising for the first time in 5 months, although it's coming off some very depressed levels, the second lowest ever, according to the latest University of Michigan survey. Let's talk about the health of the labor market and economy now with Karin Kimbrough, chief economist at LinkedIn. Karin, you are looking at the labor economy through your lens over at LinkedIn. What do you see when it comes to job postings on LinkedIn and the take-up of those job postings?
What we're seeing right now is a labor market in the U.S. that is continuing to soften. It's not collapsing. We still see some pockets of momentum, but largely this is a labor market where employers are cautious and workers are feeling a little insecure. So, for example, when we look at our data, what we see at LinkedIn is a workforce that is adding that little badge on their profile that says, I'm open to being hired someplace. And we saw a 20% increase. Yes, a 20% increase in members on our platform adding that badge in the U.S. alone in the past year.
Wow, that's significant.
Kind of a sign of insecurity. So despite this confidence measure you just mentioned among the consumer, what we're seeing amongst the worker is a little bit of insecurity. It shows up also in our own confidence measures where we say, how do you feel about getting a job, finding a job? And it's at this lowest level we've ever seen since we began this over 5 years ago.
Yeah, and we know that
yes.
Well, I was just going to say it's taking longer, right, for folks to find a job, which is an ongoing problem. So I'm curious to know where you're seeing the most hiring, the least hiring from your lens there at LinkedIn.
Yeah, so just taking it industry by industry quickly, some of the standout industries where we're seeing hiring pick up, it's actually positive, it's looking healthy. Tech, for one, believe it or not, is back in the black. It's positive. We're seeing hiring rates running around 6%. So tech is hiring, media is hiring. We also see it in healthcare, which has been a long-standing story of healthcare just outperforming in terms of hiring, and for obvious reasons. We see it in education. When you think about primary and secondary education, a lot of hiring going on there, not so much at the university level, though. So there are pockets where we're seeing hiring happen. Finance is holding in as well. Where we don't see it happening, where there isn't much momentum, is construction. Think about retail, accommodation, not seeing a lot of hiring happening there. Manufacturing is looking very depressed. So these are pockets of no momentum. And I think when you put it all together, what it tells me is that we've got a labor market that is still moving forward very slowly without much momentum, but it's got a fragility to it. If we were to get a shock, it probably would be pretty rocked by it.
Wow. Okay. So that's a great way of characterizing what we're seeing right now. I think there's also frustration for a lot of job seekers, Karin, by so-called ghost jobs. There's an abundance of listings, but when people apply to jobs, there's very little follow through on actual hiring. And it's not clear if there's a qualifications mismatch or whether maybe companies are just building up an inventory of candidates for potential positions down the road. I'm curious what you're seeing at LinkedIn.
You know what, I wouldn't put it so much as ghost jobs. What I would put it as people are finding it's taking longer to find a job. So we do see applications per applicant having been, elevated over the past year. Again, like I said, people are putting that open to work badge. They're feeling a little frustrated by a labor market where, frankly, it's a lot tougher and it's taking longer to find a job. But I don't think it's a question of just ghost jobs. I think it's a question of many more applications per job. The other thing I would say is, there is a bright spot. There are places where people are having more success, and one of them is in the small business area. So small businesses are hiring. Their hiring rate is positive relative to large businesses. So those big companies, 10,000 plus employees, they're expressing more caution. They're holding back. They want to wait and see what's going to happen with the economy, with rates, with industrial policy, with AI. But the smaller businesses are taking up the mantle. They are absolutely hiring right now.
In about 30 seconds, Karin, what's the outlook in 2026? What are you seeing there at LinkedIn? Might we start to see a bit of a loosening up and more companies willing to, expand the payrolls?
Look, what I'm seeing right now is I think that the optimism that we're seeing about the economy, the outlook from small businesses who say, look, I'm finding it actually pretty easy right now to kind of continue doing my hiring. I hope that continues. I hope that small business optimism continues because that really is a backbone for the economy. I think the bigger companies are a lot more cautious. I think that's more of a wait and see. They have a big AI play for a lot of them. So I think they're going to be more cautious.
Karin Kimbrough, really appreciate your joining us, Chief Economist at LinkedIn in Sunnyvale, California. And, Karin talked about small companies being big drivers of job growth. I think for job seekers, the concern is benefits. You might not get health insurance coverage at the same rate or in the same quality that you would at a bigger company, or other benefits for that matter.
No, it's true. But I think for a lot of folks who are just looking for the work, and to your point, the ghosting, the not being able to get an interview, going on one interview and never hearing again. Yeah. For some folks, doesn't matter if it's small or large, they just want a shot at that job.
Right. And we know companies sometimes list jobs for people they already have in mind. They just need to do it to make sure that it's out there.
And we're seeing a lot of that.
All right, well, a lot more to come here on Bloomberg Businessweek. Right now, we are looking at an S&P 500 that is in the green, up for a fourth straight day, up by 0.2%. The Russell 2000 negative by 0.3%. This is Bloomberg Businessweek.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with the developing story. SpaceX said to be in talks to sell insider shares in a deal that would value Elon Musk's rocket and satellite maker at $800 billion. Now, this according to the Wall Street Journal, citing sources. The other top story at this hour, the U.S. Supreme Court will review President Trump's planned rollback of automatic birthright citizenship, setting up a high-stakes showdown over what long has been understood to be a constitutional right. Stocks right now Trading higher, S&P, Dow, NASDAQ all advancing. S&P up 15, 68.72. That is a gain of just about 0.2%. We do have the Dow Jones Industrial Average up 153, a gain of 0.3%. The NASDAQ Composite Index up 0.3%, higher by 59 now. A down day for the Russell 2000 Index of right now, looking at a loss of 0.2% on the Russell 2000. 10-year at 4.13% with the 2-year 3.56%. Gold 42.08 the ounce, flat on the day. West Texas Intermediate crude 60.03 a barrel, up 0.6%. And Bitcoin now down by 3.1%, 89,358 on Bitcoin. Deal news: Netflix trading lower, down 2.7% right now. Warner Brothers Discovery up by 5%. Stay with Bloomberg for the latest on the deal news. Also, the other story that we're following for you at this hour: Southwest Airlines lowering its operating profit target for the full year, citing fallout from recent U.S. government shutdown as well as higher fuel prices. Southwest up by 5.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie. Alexis Christophorous here with Scarlet Fu. Carol and Tim have the day off. From the White House to Hollywood, just about everybody seems to be weighing in on this Netflix mega buyout of Warner Brothers Discovery. So let's break it down a little further with Chris Palmeri. He is Bloomberg senior editor and entertainment team leader, joining us from Los Angeles. And here in New York City, we want to talk about the legal and antitrust concerns with Jennifer Rie, Bloomberg Intelligence's senior analyst for antitrust litigation. Thanks, guys, for joining us here on a Friday afternoon. Chris, I want to start with you. There was a group of anonymous film producers yesterday who sent a letter to Congress, and they said they had, quote, grave concerns about a Netflix deal. They argued that Netflix views any time spent watching a movie in a theater as time not spent on their platform. What are you hearing in terms of industry reaction to this deal?
Well, I'll put it this way. The Writers Guild that represents screenwriters came out with a statement that said this merger must be blocked. So they always have a way with words, I guess. Yeah, no, Hollywood not happy. Everyone from James Cameron to Jane Fonda publicly saying that losing Warner Brothers would be, in some Cameron's words, a disaster. So they're not happy. The industry's already gone through wrenching change. Movie theater attendance is way down, cutbacks, runaway production, everything being shot overseas. Already seen, big mergers of MGM and Fox, and so nobody's really happy about seeing another giant deal like this.
You mentioned how the WGA, the Writers Guild Association, wants this deal blocked. Jen Rie, is this something where regulators would step in and say, hold on, we need to go through a lot of things before we give this our blessings?
Oh, I absolutely think so, Scarlett. I mean, it's got a long haul before it to get through the antitrust reviews. I'm sure it'll go into an in-depth investigation by the Department of Justice. Some state attorneys general may join in on that, and likely in the UK and in Europe as well, where Netflix is quite popular. These concerns that Chris was just talking about in the antitrust world are called monopsony concerns. And this has kind of come into focus before the DOJ in the last 5 to 10 years. And it's about too few buyers of products or services, right? And so this would be about Netflix. It's kind of two-pronged because it would be about Netflix now owning all of this content, the video creation assets of Warner. They already hire artists, writers, and talent for writing their own original scripted content. And now they'd be even a larger buyer of these services. And that could push down wages, quality of work, et cetera. For this big pool of talent. And that's one issue. And then the movie theaters are concerned too, because Netflix is a streaming entity, hasn't historically released movies in theaters, and would down the road be able to do what it wants to with new theatrical releases.
Chris, what is Netflix saying, if anything, about how they may treat movies in the theaters if this deal were to go through?
They've said they honor commitments that Warner Brothers has with films being released in theaters. A big part of this is the talent, the people that have the clout when they get these films made, want their pictures in the theaters. So that will continue. What's not been addressed is what happens after the deals that Warner Brothers made with James Cameron or whoever, what happens after that. Netflix's strategy has been very limited releases in theaters, usually just to qualify for Oscars nominations and things. It's always said its primary audience is the subscriber at home.
You know, I think about what this would mean to me as a consumer because, of course, I pay for both Netflix and HBO, and I wonder whether combining them will result in a lower price, the same price, or whether Netflix might make me pay for an extra access to HBO. Jen, how do you think about what regulators are likely to say regarding subscription prices?
I mean, that's certainly an argument that Netflix is going to make as to why this deal is pro-competitive. But I'll tell you that a company with market power promising to keep prices low doesn't really hold much sway with the antitrust regulators, because antitrust is about maintaining a market structure that lends toward competitive prices, that results in competitive prices, not the promise of a big company that, hey, we're going to keep releasing movies in theaters or we're going to keep the prices down. You know, a short-term gain to consumers in early on lower prices could result in long-term harm to consumers as other smaller streaming entities go out of business, let's say because they can't access popular content of Warner Brothers, they can't license it because Netflix, doesn't allow for that. And then it sort of leaves a combined Netflix, HBO Max able to do whatever it wants to with prices down the road. And I think that would be the concern of regulators, even though there would be an argument that early on there could be a lower bundled price.
So, Jen, what about divesting what I don't know, but would the government ask Netflix to divest something? Would they have to make some changes in the way that Skydance had to when the FCC greenlit their deal with Paramount? I think they had to scrap some DEI initiatives and do a few other things. So what might that look like here?
Well, I know it sounds strange because HBO Max is a big asset here that they're buying, but I think they could be asked to divest HBO Max. And it may be that Netflix would be willing to do that in order to get those studio assets. I think that would really solve their problems in the UK and Europe. It would go a long way to getting those things resolved, and it would solve some issues in the US as well. I would believe they would still likely have to enter some sort of a behavioral remedy with respect to being willing to freely license popular Warner content, IP, what's in the library, to some of its streaming rivals. But maybe that would be a path to getting this deal done.
Chris, jump in here. Would Netflix be willing to divest HBO Max at this price tag?
We haven't asked them and gotten an answer on that directly. Right now, their plans are to operate it HBO Max separately and kind of bundle Netflix subscription and HBO together, sort of like what Disney does with Hulu.
Right, but I mean, this is part of why it wants to buy this asset, right?
It would be very difficult to separate HBO because so much of the content is associated with Game of Thrones, The Sopranos, and that with the brand. So if they were to sell that, I mean, HBO Max is also very dependent on the movies that Warner Brothers makes, Batman, on, Harry Potter. So it's not impossible to separate, but it would certainly be tricky.
Look, let's face it, a lot of these things happen because people have relationships, right? And we were talking earlier about how Paramount really seemed to be the one that made the most sense out of the three suitors here. Does a lot of this, Chris, have to do with Netflix's Ted Sarandos having this personal relationship with David Zaslav at Warner Brothers?
Good question.
That certainly does seem to be a factor here. Ted is very well liked in Hollywood, which is shocking considering the power that they have. Other people less so. I mean, it's not like Ellison is disliked, but there's certainly a little bit of a feeling that he was a bit of a newcomer to come over here and take up Paramount and then immediately try to buy Warner Brothers. People are used to working with Netflix. Certainly the idea of Netflix having control of these franchises and being able to grow them all around the world as they've so successfully done with original franchises is certainly appealing to some people. So I think that's part of the reason why Warner Brothers went with Netflix.
Now, speaking of people to watch, Jen, I'm going to ask you a dumb question. Does Brendan Carr, the current chair of the FCC, play a role in any of this, or does he not get involved because this is cable television assets?
Yeah, he's not involved because it's not even cable television assets because Netflix
because that part of the deal is not part of it. Yep.
Yeah. So the FCC would not be involved. This would be, at least in the U.S., the Department of Justice. And like I said, probably some state attorneys general. We've already heard from California that they're concerned about this.
Chris, we're getting reports that this is not over yet, right? Paramount is now considering taking this deal straight to shareholders. Would you see that resulting in anything?
Probably not. So Paramount has offered 30, but it's Netflix is at 27 cash and stock. Plus, there's this extra value shareholders will get from the Warner Brothers cable channels when they're spun off. So Paramount might have to come out at an even higher offer. There's questions about their financing, even though they're backed by one of the richest men in the world. They've tapped some Middle Eastern funds, and Netflix being able to borrow $50 billion seems like more of a sure thing. So Paramount may certainly, try to go hostile here. Not necessarily going to work.
Jen, what will you be watching for? What are the next steps? I mean, there are a lot of investors who bet on deals and whether they'll go through or not. And this one looks like it'll take a while to unfold.
I think so, and they expect it too. I mean, they're saying 12 to 18 months before closing, but their purchase agreement gives them time all the way through toward the end of 2027. So I'll just be watching, I think, a lot what the administration has to say, because in this day and age, we do have a Department of Justice that's really pushing the policy priorities of this administration when it looks at outcomes for deals, when it's reviewing deals. And that's going to play a big part here. You talked about relationships, and it was clear that President Trump favored Paramount as the buyer, and the White House has already come out to say that they have some reservations about Netflix as the buyer. I'll be watching that to see what happens, because that's really going to tell you what the DOJ is thinking as they go into it. But this is going to take a long time. The investigation is going to start, and things are very quiet during that time, because that's really just a time period where the companies are turning over data and documents to the Department of Justice, and we don't really hear very much.
So basically, sit back, relax, grab some popcorn, and watch this thing play out.
And they're going to turn this into an HBO special at some point.
At some point, they are. Jennifer Rhee, Bloomberg Intelligence's senior analyst for antitrust litigation. Chris Palmeri there in L.A., Bloomberg senior editor and entertainment team leader. Thank you guys so much for putting it all in perspective for us. And just a quick recap of these stocks. Netflix down 2.5%. Perhaps no surprise there. Warner Brothers up better than 5%. As for the other players in this, Paramount, Skydance down more than 8%, and Comcast haven't been talking a lot about them.
No, it's like we forgot about it. They haven't come up and said anything like they're going to try to put in a bid, as far as we know right now. I mean, there's time.
And you know what? Their stock is up almost 1%. As for the overall market, we're higher, guys. The Dow Industrial is up 128, NASDAQ up 102. This is Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story, and SpaceX is telling investors it's aiming for a late 2026 IPO now. This, according to the information earlier, the Wall Street Journal reported that SpaceX was in talks to sell insider shares in a deal that would value Elon Musk's rocket and satellite maker at $800 billion. Again, developing story. Stay with Bloomberg for the very latest. Stocks paired gains after a dated reading of the Fed's preferred inflation gauge, with the S&P 500 index now climbing by 0.2%, up 15. 68.72 earlier today was flirting with records. Keep it locked into Bloomberg Radio to see how things shape out at the close. And of course, Bloomberg Television has got you covered at the closing bell as well. Dow Industrials up 155, up 0.3%, 48,006 on the Dow. Nasdaq Composite Index up 60. That is a gain of 0.3%. Bought on an up day from much of the market. Russell 2000 index of small cap shares lower now by 0.2%. The 10-year 4.13%. The 2-year 3.56%. Spot gold flat on the day, 42.06 the ounce, while West Texas Intermediate crude 60.01 a barrel. WTI right now up 0.6%, and a retreat for Bitcoin now down by 2.8%, 89,610 on Bitcoin. A deal we continue continue to talk about, a deal we are covering on Bloomberg Television and Radio, is Netflix agrees to buy Warner Brothers Discovery in a historic combination, joining the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. It is a $72 billion cash and stock deal. Netflix shares down 2.2%. Warner Brothers Discovery, WBD on the ticker, up by just about 5.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pelleton. Just to recap the breaking news that we got, a red headline crossing the Bloomberg terminal, Alexis, that SpaceX is telling investors that it is aiming for a IPO, an initial public offering, in the second half of next year. This is according to the information, which cites people familiar with the matter. And of course, SpaceX, if it were to go public, would be a massive company. It's already seen as one of the most valuable private companies out there.
Yeah, now valued at $800 billion, according to the Wall Street Journal, more than OpenAI. Pretty incredible when you think about it. We did want to see if Tesla was reacting at all, and it's actually not. It's not doing a lot of anything today.
Yeah, like you said earlier, Tesla shares are tired. They've had a volatile year. But okay, of course, we will continue to keep you posted on any further headlines on this. In the meantime, when you look at the overall business environment, there are headwinds and tailwinds galore, right? You have a massive AI spending build out. You have deal making, as evidenced by today's bid from Netflix for Warner Brothers Discovery assets. You also have the prospect of lower interest rates from the Federal Reserve as early as next week. Softer job market as well, with a lot of concerns, especially from consumers, that they might not be able to spend it the way they had been because they're not feeling as confident about their employment outlook. And then, of course, there's tariffs, too, which threatens to keep prices, if not higher, then certainly elevated. So with all this in mind, let's bring in Dr. Rebecca Homkes. She is a lecturer at the London Business School, and she's at the faculty at Duke Corporate Executive Education. Dr. Rebecca Homkes is also author of Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times. Dr. Homkes, thank you for speaking with us.
Thank you so much for having me. It's my pleasure.
So I guess the first point I want to tackle is this idea of AI, whether we're in an AI bubble. And of course, we won't know the answer until after the fact. But if AI and the excitement around it starts deflating, how much does that cast a pall over everything else that we have going on?
Yeah, the difficulty we have right now is that AI investment was the primary driver of U.S. GDP in Q2. It is the primary driver of all S&P earnings. And as you know very well, 10 companies in the S&P 500 are driving over 40% of the returns. You know, this is incredible concentration. So if a few of these big AI hyperscalers have a bit of a hiccup, we could see a lot of the other market taken down with them. The challenge with any bubble is it's not black and white, as you know very well, Scarlett. There are shades of gray. And that's what we're seeing right now. Every time we get a market earning, if it's great, we think, okay, well, this is just more a narrative that we're in an AI bubble. If it's bad, we think the bubble's starting to burst. So we're going to see this constant swinging over the next couple of quarters every single time we get one of these earnings reports for that reason.
You know, Rebecca, we've been talking a lot about this K-shaped economy, and you say when it comes to people in leadership positions, to executives, they should be leaning into that, right? Like playing into the K-shaped economy. What do you mean by that? What would that look like?
So we've now had several quarters of data and really a couple of years. We are very much into this K-shaped economy. There is a small percentage of customers, 10% of American consumers are driving half of spending. We've been saying this. We're actually already seeing this happen in the holiday shopping period. Now, this lower income consumer is still spending, right? We had some good data over Black Friday that they're still spending, but it's a different type of spending. It is very value-based. It is very purpose-driven. It is incredibly researched, right? So influencers and AI engines have a role to play, but we're seeing more research and purpose-driven than we have before. And it's now time for companies to say, okay, we're beyond the point that we can do more shrinkflation or one-off promotions or even worse, wait and see. And we're still seeing this reaction from some of the big players. So my guidance is step up and play, right? This lower income consumer wants real innovation. They want value. And it's time for companies to reinvest and think about what does innovation for this economy and for this consumer look like.
So for companies, does that mean the easy answer is to just make a play for the premium consumer?
There's no easy answers in a growth strategy, of course, and we are seeing some go that way. We're definitely seeing a very bifurcated economy and a bifurcated consumer. So if you have an offering for everybody, you essentially have an offering for nobody right now. This is really the time where we want companies to really think about who their ideal consumer is. Now, if it's in the luxury end, this is still a research-driven and purpose-based, but there is a lot more froth in that aspect of the market. So they could lean in there, but then we're leaving out a large proportion of the American consumer that wants innovation, right? They still want to spend, they still want to gift this holiday period. So that is a answer, but I definitely don't think it's the answer.
And as we are about to close out this year and look ahead to 2026, how should executives, Rebecca, be thinking about the new year in terms of expanding payroll, R&D, investing, et cetera, et cetera?
Yeah, the challenge is the macro data is very messy and it's very lagging. Given the government shutdown, we are really lacking that gold standard data we really need to make decisions. And we're going to see this reflected in the Fed meeting next week. Both aspects of their dual mandate are moving in the wrong way, but not so dramatically so, right? Inflation is high, but still within the tolerance level. The job market is cooling, but we're still roughly in that no fire, no hire narrative, though we might start to see some of those fires happening. And a lot of organizations, as CEOs are looking to make their growth strategies for next year, are facing this environment. The challenge that we have is we look at all of these data points to try to get a reading, is it good or bad? And that's not how we should be looking at data as executives. We should be looking at data for insights. What does this data tell me about what my growth insights are and leading on to those? We unfortunately look at uncertainty and tend to frame it as negative or bad. And when things look gray, we assume it's going to be a downturn and start planning that way. That's not the view we should take if we want to perform in this world. It's about seeing uncertainty for what it is, a series of future events which may or may not occur. And whether or not those events are good or bad depends on what that organization is trying to do and how they're set up. So I do think on a macro level, we're going to see a real more lean into an AI investment. Many companies are really just starting to go up the curve there. R&D and innovation are looking a little bit mixed across different sectors, depending on where you're set up right now. So I think we're going to see it next year, and that'll be interesting. We're going to start seeing it coming on through earnings from next summer as well.
So, Rebecca, what is the black swan, or what's the one thing that you really worry about that keeps you up at night that you think executives, would kind of freak out over if it were to happen?
Well, executives freak out over quite a lot of things, but I tend to be a pretty preliminary bull and try to reframe everything for what that possible insight would be. There's a couple things that we should be looking for, though. This AI investment bubble right now is very much built on anticipated demand. If we get a few industry leaders, non-tech, come out and make pretty firm statements that they're pulling back from AI investment, that would have real market implications. So, of course, we're looking for that. We're also in an environment of extreme political and geopolitical uncertainty. So any big changes to more trade policy or regulatory policy that really upends industries, that could shake a lot too. So kind of anything in the AI bubble, geopolitical uncertainty, and the extreme policy uncertainty. If we could get a little bit more stability in the political landscape, that would actually do a lot to helping some of the economic uncertainty and the labor market. If you actually dig into the data that we're seeing from the recent job reports, a lot of this is saying, I'm just waiting until I have a bit more certainty coming up. So again, there's lots of things that could happen. Those are the couple things I'm most looking out for.
All right, thank you so much. Dr. Rebecca Homkes is a lecturer at the London Business School and faculty at Duke Corporate Executive Education. Alexis, we need to go back to the breaking news that we were telling everyone about just a few moments ago. SpaceX telling investors that it is aiming for a late 2026 IPO. This is according to the information. SpaceX is mulling an IPO of the entire company, in fact, according to that publication.
At an eye-watering valuation of $800 billion, far surpassing OpenAI's record-setting $500 billion. So we want to bring in Bloomberg Tech co-host Ed Ludlow, who's in San Francisco, and on top of all of it for us about this SpaceX IPO deal. First off, Ed, I guess it was a question of just when, right? Not if it was going to happen?
Yeah, I just want to correct and clarify some things for you guys. There are two distinct things here. There is a tender offer, which is an insider share sale, where basically SpaceX does this annually or biannually. It allows employees and early investors to sell shares at a specific price and therefore valuation to give them some liquidity. So the Journal had reported that this tender was at a share price that would give a valuation of $800 billion, double what we believed the valuation to be earlier this year. I'm hearing that there is a tender underway. It could close by Monday, but actually the share price I was hearing is much nearer to $300 a piece, which would put the valuation nearer to $600 billion. So this is a kind of live situation. The IPO part of it is separate. That, you know, in communications with investors, the company is saying that in the second half of next year, 2026, they'd look at an IPO, and the bit you're right about is that it would be the whole company. Previously, we reported that one of the ideas was that SpaceX would spin off Starlink, its space-based, constellation-based internet service, rather than the whole company. But, you know, that is contrary to what the information's put out this morning.
Right. Okay. Thank you for clarifying that. There's a lot going on here with SpaceX, and we know investors are hungry for any information they can get on it, because right now it's privately held, and so you can't really get access to it. Having said all of that, Ed, Elon Musk would be the CEO of 2 publicly traded companies if this happens. Does his current contract or his current setup with Tesla allow for that?
Yeah, I mean, as you know, Scarlett, we spoke to Tesla's board chair, Robin Denholm, about this exact idea twice. The board seems comfortable based on the compensation agreement, which has now been ratified by Tesla shareholders, that Musk continues on at the helm of other companies. And actually, the board went a step further to say that there's value in Elon Musk having interaction with these companies, because in the future, they basically believe they're highly analogous. You know, if you think about space-based internet and where this market's going right now, a very big concentration on the potential for space-based data centers, they will see it as a kind of value add to have the relationship between the 2 companies. The technicalities of being the CEO of 2 public companies, no idea. You know, that will come out in the wash, right, when they talk to investors about it. But remember that SpaceX does have highly capable executives in President and COO Gwynne Shotwell, who runs the place day to day. And then Brett Johnson, the CFO, is the guy that does all the money talk with investors anyway.
I wonder if this is going to make Jeff Bezos want to take Blue Origin public.
Ooh, good question.
Yeah, it's a great question. I mean, like, look, it is an expensive endeavor to first get the company off the ground, pardon the pun, for launch companies. But at this point, the difference with SpaceX is that they have changed the economics of launch and then deployment of Starlink. The reason that we talked about at one time, this was in 2024, spinning off Starlink as opposed to an IPO of the whole company, is that A, the revenues from Starlink now eclipse launch. But B, it's a much higher margin, cash flow positive business. There isn't a lot of profit to be made in launching rockets into orbit. But also, Musk has been quite transparent that it tops out. There's only so much money you can make from doing that. And so Blue Origin is much earlier in its life cycle, getting the economics right of launch, but also the other things it wants to do beyond just putting things into orbit.
All right, good stuff. Ed, always appreciate your hopping on. Ed Ludlow is Bloomberg Tech co-host, speaking with us about this report from The Information that SpaceX is telling investors it is aiming for an IPO in late 2026. All right, let's take a look at some stocks on the move. We're about just over an hour away from the closing bell here on this Friday. I'm Scarlett Fu with Alexis Christoforous, and we're joined now by Bloomberg News equities reporter Natalia Kniazhevich. And Natalia, you're looking at a number of companies, but we first have to start off with the ones that are in the headlines all day.
Exactly. The deal everyone is talking about today, Netflix is buying Warner Brothers. So Netflix, the ticker is, of course, NFLX. Shares are down by 2.4%. Warner Brothers shares are up by 5.2%. The ticker is WBD. So, of course, it is a huge deal, cash and stock. It values Warner Brothers at $82.7 billion, including debt. So Warner Brothers will spin off cable networks such as CNN and TNT into a separate company before concluding the sale of its studio and HBO to Netflix. So, of course, Netflix will get a big library of programming and studios in California, which gives it competitive advantage over Walt Disney and Paramount Skydance. To some investors, actually, this is a question that what if Netflix is doing this big acquisition because it cannot sustain its business or expand its business at a big scale. However, we'll see. At least it is a good deal for Warner Brothers shareholders as stocks.
Yeah, I'd say Netflix would be paying a pretty penny for the rights to be able to do that if it couldn't sustain things on its own. All right, let's move to beauty, because Ulta had a really nice quarterly profit report after the closing bell yesterday. Stock is up nicely as well.
Exactly. The ticker is ULTA. Shares are up by 13, almost 14%. That's actually the highest level ever. The company posted better earnings results, also boosted its guidance, and analysts saw really strong sales across all major categories, but they highlighted specifically fragrances and skincare. As for 2026 forecast, the company sees net sales at $12.3 billion, previously expected 12 to 12.1. But notably, just this summer, the company was very cautious about consumer spending. Now it looks like it's a kind of turnaround.
All right, so the more robust outlook in the second half of the year. Let's finally let's wrap it up with VSCO.
Yeah, so Victoria's Secret shares jumped by as much as 20% today. That was the biggest move since 2022. Again, strong sales, strong outlook, and comparable sales rose 8% last quarter. Victoria's Secret saw spending, really robust spending across all income categories. And the company said that they see customers are buying more full price items as it tries to go away from really strong, heavy discounts. Now, there's also some data showing that traffic was really strong on Black Friday, and some analysts say that this positions Victoria's Secret really well ahead of the rest of the holiday season. But overall, the company was really a little bit cautious about post-holiday period, so we'll see how it plays out.
All right, thanks so much, Natalia Kniazhevich, with those stocks to watch. And for more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or wherever you get your podcasts. We have a nice rally underway here to end the week on Wall Street. Still about an hour to go before that closing bell. Dow Industrial is up 174 points. We've got the NASDAQ gaining about 77, and the S&P 500 up 18. And we also have that news about SpaceX here late in the day, Scarlett. SpaceX now telling investors it is aiming for a late 2026 IPO of the entire company.
Right. This is according to the information, which cites people familiar with the matter. And these discussions come as SpaceX considers selling shares held by insiders that would value the company at $800 billion, making it the most valuable private company in the world. There's a lot more to come here on Bloomberg Businessweek. But for those of you watching on television, up next is The Close with Romain Bosick and Katie Greifeld. We're looking at stocks ending the week, at least right now, on an up note.